Welcome back to Quants Worth Following. Today, I have not one, but two amazing guests. I guess before we begin, first, Ben and Roman, can you both actually introduce yourselves? And yeah, would love to hear in your own words.
Ben, please go ahead.
So Ben Orthlieb, I'm a co-founder with Romain of 212 Angels, or 212 as it's evolved. We are a quant seed fund, basically started on the idea that VCs talk about tech and AI all day long, but they use none of this for themselves. And so we were more inspired when we started by the story of folks like Renaissance Technologies. The first thing we did, we started using machine learning to evaluate founders. And from there, we never stopped building. So we now have AI at every step of the process. Beyond that, my recent experience includes being head of M&A and investments at LinkedIn. And I'm originally French. I have both a MBA, a CFA, and an engineering degree, which makes me very sort of schizophrenic about this whole process.
It's amazing. Roman, I don't know if you want to introduce yourself as well.
Sure. Yeah, super quick, Romain, co-founder of 212, also originally French. I've been for 15 years a French diplomat and then, changed path and joined more than 10 years ago the French Sovereign Fund. So I've been in the investment world for 10 to 12 years now. And I met with Ben like 10 years ago, playing cards. And since then, we never stopped talking about how to use data in tech while investing in tech, hence 212.
Amazing. Thank you for that overview. I'm curious what inspired you to start 212? And I know that, you want to take like a quantitative approach, but curious, what that was like.
I think it comes from a number of elements in the origin story, if you will. Romain and I have known each other for over 10 years. One of our topics has always been a better understanding of the VC world with data. I also did work at LinkedIn with the data science team and Reid Hoffman on using signals in LinkedIn data to find potential sort of sources of success in startups, which gave some results, but after Series B, but sort of put us onto this idea of using AI and signals for startup investing. And then finally, we got our start as scouts for Emergence Capital, where we quickly realized that being an investor is highly ineffective because they rely on traditional networks and very little actual qualification method, which is where we started using machine learning to evaluate founders we should be talking to because they're more likely to succeed. And then from there, built everything else.
But basically, we thought it was weird, for people who invest in tech, that those same people don't use tech for themselves.
That's a wonderful way to put it. The large majority of VCs out there are very qualitative, right? They're not very quantitative in their methodology. I would be curious, are there any kind of pros and cons in using a more quantitative methodology and what that's been like so far?
Yeah, lots of pros. For example, you can scale activities, operations. When you do things like traditional way manually, you are limited with your available time. Basically, VC venture is a function of time, resources, and network. Once you use tech, you don't have any limits anymore. So you can source thousands of people, screen thousands of people, reach out to thousands of people at the same time. The other pro is that, at least on paper, there is no reason why a machine would not be better or at least have more knowledge than a human. In other words, every fund has an analyst, junior or senior, but a machine can read any papers, any blog posts, absolutely everything, remember absolutely everything, and listen to all the podcasts, all entrepreneurs' interviews, and learn from them like every minute. So on paper, a machine should be at least as good as a human, at least, for basic analysis of any company. But we still need human decision in the loop. That's what we do, because especially when you do seed, even Series A, when you do early stage investing, humans matter. The only thing that really matters is, the entrepreneur, like yourself. And for that, at least for now, humans like us are a little bit better than the machines to really understand what's behind the brain, what's really in the mind. And so at the end of the day, it's a human decision.
Maybe to share a little bit what we use in terms of quant and tech in the background at a very high level. I think the first insight, a lot of VCs will tell you there's no data at early stage, which is why some later stage funds, oftentimes hedge funds, actually do quant on venture because you can buy credit card receipts, etc. But early stage, most people say there's no data. The insight, if you want to call it that, is that at the early stage, 90% of what matters is actually the founders like you. That's how we found you. And that's what our first tools were geared on. And so purely from a who are our agents, if you will, we have Agatha, the precog, that helps us source and evaluate founders outside in. We generate 2 to 3 times more deal flow than any of the large VCs, top of the funnel, and Agatha tells us who to meet. Then we have Da Vinci, as Romain was saying, which is basically my venture AI associate with whom I can have a conversation literally after a meeting. So Da Vinci will tell us notes about companies, good resources, and we can dive deeper. We have Kojak that manages the portfolio monitoring, and then finally Slash that manages all the automation. So that's the suite of agents, and Agatha being the real quant one in terms of telling us, it's not like public markets where you know what your universe is. Seed is actually very well known for being obscure and you know deals after the fact, etc. And so Agatha is both helping us find as many deals as possible top of the funnel, and we estimate our coverage to be about 70% at this point, and then tell us who are the 5% of those companies that we should spend time on.
Absolutely. I was also going to say, by the way, so 212, you guys were one of Databento's first investors and found us way before we launched, before, the general public knew that we existed, right? And one thing I appreciate about your due diligence process, just speaking from a portfolio perspective, is how transparent it is, honestly. It's the transparency that is so valuable to us. A lot of times, an investor will kind of tiptoe around, we'll get back to you and talk to the team and get back to you sometime, and they never get back to us. That's the end of the whole conversation. For you guys are like, hey, we'll get back to you tomorrow by noon, right? And I love that it's very transparent. That's the whole, actually, if you could explain the history of your name, that would also be very helpful too.
Well, so the name of the process. Our process is we do 2 Zoom meetings and we give our answer the next day of the second Zoom at 12 p.m. Pacific time. First Zoom is on classic, conversation on the product, the market. And the second Zoom is really with all co-founders, and it's really about the personality and their life, their upbringing, what happened, their family and this kind of stuff. Basically, we do small checks, but it's a question of respect due to the founders. I mean, you cannot drag conversations forever. The founder must be at the center of your design, of your processes. So we thought, hey, especially because we get small checks, but even that, we have to be transparent, fast, and just out of respect for the founders, the answer next day at 12 p.m. so that they can move on or take out check, whatever. But it's just a question of pure respect.
Absolutely. Yeah. And that's something that as a founder, we really appreciate because our time is very limited as well.
Yeah.
It's on building, not fundraising forever. So that's always something wonderful. And then after the fundraise was over, one thing that actually surprised me is how much you guys continue to help us out on a daily basis. You answer all of our newsletters. You don't have to, you don't have to do that, but you respond to all of my emails. Yeah.
Actually, an internal rule, we will respond to any updates because it shows you to the point of like, people will never respond to you. You don't know if people are reading it. Mm-hmm. We read it, and we want to make sure that that we're following and if we have questions and if we can help. So we generally strive to answer within 24 hours.
Exactly.
It's also a question of respect. I mean,
Yeah.
Basic stuff.
Thank you. I really appreciate that. And the other thing I should mention is the fact that you guys have a portfolio community is also fairly rare. And it's a community where I've met some of the other founders in your portfolio, and we went through some sales training together. We went through some CEO coaching together. And these are all programs that you guys did, as a part of the value add to founders. And that is priceless to us, by the way. The sales coaching material, I actually send that to now all of my sales colleagues whenever we hire someone new, we'll send them the material, and it helps them understand, okay, here's how we should approach sales today in the modern day era. So the work you provided us is more than just investment. It really is a lot of other things on a daily basis that I can attribute many kind of things to you guys, and also many introductions, by the way. you'll help us curate lists of investors for future rounds. I remember when you sent us a list, I was like, this is too good to be true. I can't believe it. Yeah, it's not just one investor. It's like you sent us a whole list of investors that you know about and could be a fit for us, and the fact that you're able to mass email and really put in the time for us really meant a lot, because especially back then, like we were not the most successful company at all in your portfolio. We were struggling to get to launch. We were at a stage that was very tough for us. And the fact that we're able to get through those hurdles, a lot of it was thanks to you guys. And so, yeah, I'm really, really grateful from the perspective of a founder as well.
Appreciate it. Thank you.
Yeah, I guess my next question, I'm just curious on what types of LPs invest in your fund? Like, are you raising now? Like, where are you in the life cycle of your fund?
So there's multiple types of LPs. There are some VCs that for signaling and sort of close proximity, our model is to be collaborative. And so a lot of VCs not only like the model originally, but when we do demos of our tools to them right now are completely wowed. And so they invest as a show of sort of ecosystem support. We have historically a number of tech and entrepreneurs, operators, where it's interesting also, we have a number of quant and hedge fund people. And some of those are the easiest conversation because people are like, of course, VC should use data. But the VCs do not use data. And so when we explain our model, we make demos, people are like, okay, I get it. I love your model. I'm going to show support. I'm going to invest, those type of things. And so we do have some very well-known like historical hedge fund managers. We're talking to some very prominent hedge fund managers in the next few weeks. So that's definitely a big community for us, because in many ways, again, back to the origin story, we're inspired by folks like the stories of Renaissance, etc. Yeah. Side note, the only fund that we found that is close to us in approach and in a number of the elements of the strategy, the focus on founders, the automated help for industry analysis, focus on the co-investors as signals, is actually Coatue.
Oh, wow.
And the person in charge of their early stage venture is actually the ex-CTO of Atlassian, and he was head of data science as well before that. And so not surprisingly, that DNA led to the only other sort of similar model that we found. Anyways, and then after those folks, going back to the question of who are our LPs, sort of family offices, oftentimes with entrepreneurial or finance background.
Awesome. And then, yeah, would be curious about, I don't know if you're allowed to say, are you currently in the middle of a fundraise now? Are you about to fundraise? Like, curious on if you're allowed to say any of that right now.
Yeah, we just did our first close and we do a second one before the summer and hopefully a last one before the end of the year.
Amazing. Congratulations. That's awesome.
Thank you.
I figure raising a fund must be even more difficult than for us raising funding in terms of, just right now, the timing, the markets, the dry powder, the availability of LPs out there is quite difficult. So for you guys to be able to raise a fund at this time is absolutely incredible. And I think goes to show the track record that you've been able to gain. So really congrats. Really excited for you.
I mean, it's different. Funding for founders is extremely hard. The difference with LPs for a fund is oftentimes the timeline are less sort of strict, and so people use that to slow roll. I would say a few things to what you just said. The environment is absolutely horrible. Our vintage, we know that a third of funds are already underwater and basically not re-raising, not able to re-raise, so dead. That said, of course, now that, 4 years ago when we started and we met you, the sentiment on doing venture with AI was, yeah, you're crazy. Then ChatGPT happens, and so it's more in the air. And now there's a lot of basically slideware of like, oh, we're doing stuff with data. That's why we do demos so that people can actually see our agents in action. But 4 years ago when we started, it was a bit of a project experiment, prove that you can indeed build a VC with data and AI. Today, I won't get into all the details, but we are basically a top 1% fund from our vintage. And we don't claim brilliance or VC insights or anything like that. We've claimed a good process that is repeatable, that is designed to produce these type of outcomes that we're seeing not in TVPI, but that we're seeing in sort of operational metrics and early investment metrics, traction of the startups we back, etc.
I love that. Yeah, I was going to say that one of the things I really appreciate about you guys is you're not the kind of, there's different types of VCs. And I appreciate there's a kind of VC that is on Twitter and they tweet like 1,000 times a day. They're influencers for better or worse, right? And I get that. But I appreciate that you guys are both really successful in your own respective careers and you started this VC fund and you're able to pick up on so much like quant methodology before it became, even now it's still kind of slowly picking up. I think with some funds are starting to be a little bit more quantitative. But on top of that, I think it's the help that you provide us behind the scenes is just so valuable to us. It's something that we really do appreciate. So yeah, one of my other questions I had is maybe what are some of the biggest challenges or surprises that you faced so far in the process of running a VC fund like this and doing a quantitative methodology, like anything that has surprised you so far?
One of the elements is, and we still see it today, people don't think that you can do venture with quant. And so there's a culture that we sometimes work against, even in the people we work with. What I mean by this is if you're a hedge fund, you start with the assumption of data, quant analysis. That's not how any venture firms were started. And so becoming more data-driven, more quant-driven requires a complete culture shift. And so when we try to help some of our close friends learn from a little bit what we've done or to implement things similarly to what we've done, you can see this real sort of problem. And so the way it manifests itself is some GPs understand that we use Agatha to source and screen, but because it attacks their personality almost as a VC, like, oh, I'm a good picker, that's who I am. They almost do away with all of this. So they take intros from us, but they almost pretend our business doesn't work the way it does. So it leads to these interesting sometimes conversations. Same with LPs, where it's like the results are now showing a lot of VCs have done deals out of intros we've made, and yet it still sort of bothers some of them the way we approach the market.
VC is a craft. This is what we hear the most often, almost twice a day. VC is a craft, which is true, but less and less.
Yeah, no, absolutely. I totally get that. And I think at some point you're both absolutely right that there's a lot of early stage. How do you find these deals? Traditionally, it was by just personal connection, but is there a way to source for more, right? Can we look at the entire market outside of our own purview, right? And do that. So I think that you guys make a really great point of being able to look outside of your marketplace and look at historical data. Historically, what kind of startups, what industries, what kind of profile of founders have succeeded in the past, right? Similar to what we do with stocks, in the hedge fund,
exactly.
we're trading, 100%. Right? Instead
Yep.
of guessing whether Google stock will go up or down tomorrow based on sentiment and how I look at the CEO, like CEO talks, whatever, like I can also look at historical data and see, okay, well, typically when these things happen or when Google trends with Microsoft for whatever reason and think these patterns happen, that pattern is likely to repeat itself again, right? And so I'm sure similarly with you guys, you're doing that, but just applying those methodologies into venture investing, which is really exciting. So it sounds like you're ahead of the time in terms of, now AI is becoming more popular. So some folks are starting to get that idea like, hey, we could use AI in venture investing ourselves instead, not just investing in AI companies, but, also why not just use it ourselves? So I think that's really inspiring and really cool to see. I guess my maybe final-ish question for you is what advice would you have for aspiring VCs who, there's a lot of folks I've talked to recently who are hoping to one day start their own venture fund, launch a fund. So curious on any advice you would give to them.
So, Ben, if you're okay, I'm going to start with this one. Depends on the stage they're investing in, but I guess usually it's mostly early stage, right? Pre-seed, seed. Advice number one, your enemy is adverse selection. I repeat, your enemy is adverse selection. So, which means unless you already have some sort of brand with funders, the risk when you start investing at early stage is that the deals that you can win probably are the worst. Especially, if you get large checks, if you design your fund to, let's say, co-lead or even lead rounds, adverse selection is your enemy. That's the reason why, by the way, we don't have any brand. So we started with small checks. We don't lead to avoid adverse selection. And that's a huge thing in venture.
The math is easy. The top 50 brands, top 50 investors in venture do about 20% of the deals, but capture 75% of the unicorns. And that's where venture is funny because there's always type 1 and type 2. So you can always write a story either way you want in TechCrunch. But when you actually look at the data, if you're not investing alongside top VCs, you're basically burning money.
Yeah. Maybe a second advice, super quick. A lot of LPs tell GPs to be different, to be unique. Maybe the advice is to be unique, but in the eyes of the funders, not in the eyes of the LPs.
I guess like a good way to put it, right? Because from a perspective of a founder, one of the things that a lot of founders kind of make fun of is sometimes when we have due diligence calls with VCs, right? The first question is, who else is investing? And I'm like, wait, aren't you supposed to do your own due diligence? Like, who cares what the other investors think, right? Like you should make your own decision. But when you put it in that perspective, like, hey, right, the top VCs tend to perform really well, right? And if you look at that data and, obviously you want to trend follow the top VCs, that makes a lot more sense to me
Yeah.
from a founder perspective. And hopefully that'll help other founders understand why a lot of VCs care deeply about who else is also involved in the round. So yeah, that's
If I can be a little sneaky, we do this and we say it. I just told a founder, because we know the data. Most people do it because they're lemmings. It's a very different thing. But yes, it's a question of size. If you are writing a lead check, you shouldn't care. If you're a lead check and you have a brand, you shouldn't care who else is in the round.
Yeah.
But if you're writing a small check, angel type, you should care about who's in the round.
Absolutely. Yeah. Thank you for those insights. It's super amazing. And I appreciate you both being on Quants Worth Following. You guys are hopefully first of many VCs who will join us in the quant community here. So thank you so much again. I really appreciate it. And looking forward to hearing more from you guys in the future.
Thank you, Christina.
Yep. Take care, guys. Bye.